Welcome back to the Deep Dive. If you're trying to make sense of the post-earnings chaos around i3 Verticals, that's IIV, well, you're in the right place. We are jumping straight into their Q4 FY2025 earnings call. It was held pre-market on November 18th. And this call was, it was just massive. This was supposed to be the big reveal for a story they've been building for years.
Yeah.
i3 Verticals has been trying to shed its old payments businesses to transform into a single segment, pure play public sector software provider.
Exactly. They made these two huge divestitures, and this call was meant to be the clean payoff, the we did it moment.
Right.
And that's really what sets the stage for the drama that we saw. The market wasn't just hoping for good results. It was, frankly, price and imperfection. If you look at the run-up to the call, the stock was just monster performer at almost 25% in just the last 3 months. It was completely torching the general software index. So, expectations were just sky high. Everyone was excited about this high-margin recurring software story finally becoming, clean and simple.
Okay, so let's get right to it. The numbers for the quarter ending September 30th, they weren't straightforward at all. They were mixed. And that mixed signal plus all that anticipation, it just created the perfect storm for the stock crash we saw. So, starting with the top line, revenue from their continuing operations came in at $54.9 million.
Which was a beat.
It was. It successfully edged out the street's estimates. Those were floating around, $53.6 to $54.8 million?
Yeah.
So it's a pretty decent 7% year-over-year growth. And for the full year, they hit $213.2 million. That's up 11.5%. So on the surface, top-line execution looked solid.
It did. But here's where the story immediately gets murky for investors. And, you really have to understand the difference in accounting here. On the adjusted profitability side, which is the number the company always wants you to focus on, they delivered a really meaningful beat. Adjusted diluted earnings per share from continuing operations hit 27 cents. The consensus was 24 to 25 cents. So that's a 13% beat. Pretty strong.
So far, so good.
Right. But then the picture soured really fast when the market looked at GAAP EPS. That's, the standard accounting principles.
Now, what was that number?
The reported figure was just 20 cents. That's a huge miss on the GAAP consensus of 26 cents. And that swing beating on their adjusted number, but missing so badly on the GAAP number, that was the first real red flag. It suggested the cleanup process might still have some messy financial leftovers.
That's what's so fascinating here. Historically, the market often gives companies a pass on a GAAP miss if the adjusted number is a strong beat, especially for a growth company that's in the middle of a pivot.
Usually.
But not this time. The initial price action was just sharply negative. It's almost like investors took one look at the Q4 beat, shrugged, and then immediately flipped the page to the next section. The forward guidance. And that.
Yeah.
Well, that's where the real pain was.
And before we get into that guidance disaster, we should probably take a second and just appreciate how successful the strategic pivot actually was. Because the qualitative picture here is, it's pristine.
Right.
i3 Verticals sold off their non-core merchant services business last year. And then in May of 2025, they finished the job selling the healthcare RCM business for about $96 million.
Let's just pause on RCM for a second. That's revenue cycle management. For anyone not familiar, it's basically the whole messy process of tracking patient revenue from the moment they get a service to the final payment.
It's super complex.
It's complex, it's high friction, sometimes it's pretty low margin, and it just doesn't really fit with selling enterprise software to, state and local governments.
Yeah.
Getting rid of it was necessary surgery.
Absolutely. The whole goal was purity, and they got it. They are now officially a pure play public sector enterprise software provider. Full stop. And you can see the results of that cleanup in the underlying metrics. Their annualized recurring revenue, ARR, grew 9.2% year over year to $165.3 million.
And that ARR metric is so key, right? It's the predictable future revenue stream.
It's everything.
And their really high-value streams are picking up speed. SaaS revenue, that sticky subscription-based software money, was up a phenomenal 23% year over year.
Which is huge.
So as a result, recurring sources now make up about 75% of their total revenue. That is the exact profile that software investors pay a premium for.
And then there's net dollar retention, or NDR. This basically tells us if they're keeping customers and getting them to spend more. For FY 2025, their NDR was 104%.
So the average customer is spending 4% more with them this year than last year.
Exactly. That is a hallmark of a really healthy enterprise software business.
So let's talk about the financial firepower this pivot created. Q4 adjusted EBITDA from continuing ops was $14.4 million, with margins at 26.2%.
Mm-hmm.
But what's more important is the full-year adjusted EBITDA margin actually improved. It went up to 27% from 26.4%, mostly because all those corporate costs tied to the businesses they sold just vanished. They got leaner.
They got cleaner.
Okay, I have to jump in on the balance sheet because this is the detail that just makes the stock price collapse look so insane.
Go for it.
They finished the quarter with over $65 million in cash and, critically, zero debt.
Zero.
Zero. For a software company that just shed its non-core assets, that's a huge war chest. What are they even planning to do with all that capital?
Well, that is the core tension of this whole story. They have immense financial flexibility now, not just for investing in their own products, but they explicitly said they expect meaningful M&A activity next year.
So they're going shopping.
They're ready to go shopping for some nice little tuck-in acquisitions in that public sector space.
Okay, so we've established it. The pivot was a success. The underlying metrics look great. The balance sheet is pristine. But all that good news was just completely wiped out by the guidance.
It was a bombshell.
The conservative FY 2026 guidance, this is the source of all the pain.
Right.
They guided for FY 2026 revenue between 217 and 232 million. The midpoint there,
Yeah.
it's about 224.5. That translates to growth of just 2 to 9%.
Ooh.
Yeah. And that midpoint is about 4% below what the street was looking for.
And that disappointment just bled right into profitability. The adjusted EPS guidance for FY 2026 came in at $1.06 to $1.16.
Which means the midpoint is what, $1.11?
$1.11, which
Wow.
is about 8% below the consensus of $1.20. And look, when your stock is up 25% on a high-growth story, missing revenue by 4% and EPS by 8%, that's a narrative killer.
I have to challenge this, though. If they just finished this big pivot and they're focused on high-growth software, why are we seeing a 2% growth number on the low end of that range? Are they failing or are they just lowballing everyone?
Management swears this is a strategic choice, not a failure. And this is the most critical piece of the whole call. They say they are deliberately shifting how they negotiate deals. They're prioritizing higher margin SaaS and recurring revenue, even if it means walking away from some lower margin professional services revenue in the short term.
Okay, so professional services, that's like implementation, customization, that kind of thing.
Exactly. It's often lumpy, it's lower margin, and it makes their valuation look less like a pure software company. So by cutting back on that PS revenue now, they're sacrificing some 2026 revenue for a much healthier, higher multiple business profile in 2027 and beyond.
They're trading growth volume for margin quality.
That's the perfect way to put it.
But that wasn't the only reason, right?
Yeah.
They also mentioned some timing issues.
Yes, that's the other piece. They flagged a temporary dip in project cadence, specifically in their utilities and transportation markets.
So new projects are slowing down there.
For now. And that's expected to cause a big drop in that non-recurring professional services revenue, especially in Q1 of 2026. Management was clear, though. They expect those markets to bounce back strongly starting in FY 2027. But the timing is just causing a huge short-term headache.
It's interesting because even while they're guiding down, they're setting up these other long-term growth drivers.
Right. They highlighted that huge statewide contract win with the Supreme Court of Appeals of West Virginia. They're deploying their i3 Corton case management solution. That's a massive platform validation.
And maybe even more important, structurally, is the pricing. They are finally getting aggressive.
Yes.
Management signaled a move toward normalized 3 to 5% annual price increases across their contracts. They even admitted they've been too conservative on pricing in the past. So this provides a new, durable tailwind for growth that the market isn't really factoring in.
Okay, so let's talk about the market reaction, because it was just brutal.
It was.
The stock traded down from a close of $29.02 and finished the day near $25.97. That's a drop of about 10.5%, close to close.
But the intraday swing was insane.
Oh, completely. You saw the stock trade down as much as 24% at one point. It hit a new 52-week low.
And the volume tells the whole story of the panic. Trading volume was around 776,000 shares. That's nearly 3 times what they normally do.
Which tells you there were some big funds resetting their positions. They were anchored to those old aggressive estimates, and they just had to get out when the soft guidance hit.
And this created that huge split we talked about. You had the analysts on one side and the investors on the other. Sell-side analysts like Benchmark and D.A. Davidson, they maintained their buy ratings.
They did. They were citing the strength of the long-term story and those, absolutely breathtaking gross margins.
Think about that for a second. A gross margin of around 90.7%. That means for every dollar of software they sell, 90 cents is gross profit.
It's an incredible number.
And that's why the analysts can afford to look past the short-term noise. They're focused on the bones of a high-quality, scaled software business. But the buy side, staring at their screens, they were just completely anchored to that disappointing 2 to 9% growth outlook for next year.
It all just comes back to managing expectations. The stock was up so much, the market was priced for perfection. So when management came out celebrating the pivot, but then paired it with that conservative forecast, it was an instant punishment.
All right, now for our favorite segment. This is not financial advice. We take the source material and we brainstorm the most outrageous yet plausible trade idea.
And we have 3 key variables here that are just totally misaligned right now. 1, the stock is deeply oversold, trading near a 52-week low.
Right.
2, the company has an enormous pile of cash, over $65 million and 0 debt. And 3, they just refreshed a $50 million stock buyback authorization.
And despite the sell-off, the options market is still showing conviction. The put-call ratio is super low, around 0.07, which is very call-skewed.
Okay, so given management's conviction that this is all temporary, that this is a strategic shift and not a fundamental failure, here is the pitch.
I'm ready.
i3 Verticals should immediately halt all non-essential M&A talks for the next quarter. Forget about those little $2 to $5 million tuck-ins for now.
Yeah.
Instead, they should execute a rapid, aggressive, just overwhelming stock repurchase program. Use the entire $50 million authorization or a huge chunk of that $67 million in cash and do it now.
Whoa. So they just go all in on their own stock.
All in. This move would signal absolute, undeniable management conviction that the stock is critically mispriced in the low 20s, that it's down because of temporary timing issues and their own conservative guidance.
It would stop the bleeding for sure.
It preempts any more downward pressure, and more importantly, it lets them capture that value gap. They would be using their own cash to buy back future recurring revenue growth at a huge discount instead of chasing some expensive private M&A deal.
So it completely flips the script. The market's complaining about slow growth, and management's response is, we agree the stock is cheap and we're putting our cash where our mouth is.
That would definitely get the market's attention.
Okay, so to wrap up this deep dive, the tension just couldn't be clearer. You have this incredibly strong Q4 execution and a successful pivot.
A beautiful pivot.
Contrasted so sharply by this conservative FY 2026 guidance, which is all driven by lumpy project timing and a strategic shift away from lower value contracts.
Right. So the final thought we want to leave you with is this. Will these structural moves toward more recurring revenue, plus those new 3 to 5% price hikes, deliver the kind of durability that ultimately earns a premium valuation? Or will this short-term guidance gap just keep punishing the stock until we get closer to FY 2027?
Do your own diligence. And thanks for taking the deep dive with us.